88 pre-market. Joining us now, Jim Lebentha, Chief Market Strategist at Celerity, right? Cerity, sorry. Partners. He's part of CNBC's Halftime Report Investment Committee, of course, and also the author of the new book, How to Ride the Subway, Getting Around on Wall Street and in Life. We'll get to the book in a minute. I want to get your thoughts, though, on what is going on in the markets. It feels like we are on a dual track almost when it comes to signaling about the war. We have what President Trump is saying, but then we have the reality of the Houthis joining the fight, of potentially blocking some more oil supply. And so you have the two sort of things are getting better, things may be getting worse. And here we are with the futures higher.
Yeah, so it really is about getting those tankers through the Straits of Hormuz. And one of the things we all know is that the market is going to anticipate this. So we are in the fog of war. You know, we're hearing things from both sides. The market may this morning be saying, okay, this thing is going to get worked out over the intermediate term. I do have to say, Melissa, over the long run, I think when we're here 3-5 years from now, we're going to see a lot less global dependence on the Persian Gulf. I think whether it's LNG exports from the U.S. or alternative geographies for crude oil supply, I think this is the straw that breaks the camel's back as far as Persian Gulf dependence goes.
How about how it plays out in the next, I don't know, month or two? I mean, I know we're in the fog of war, but so many people have said, 4 to 6 week excursion, and we are entering the 5th week of war right now. And I feel like a lot of the strategists we talked to throughout the day, whether it be on the halftime report or closing bell overtime or fast money, saying, it's going to be short term. We're going to look through it. It's like the clock is ticking at this point.
Well, the clock is ticking. I don't want to minimize what you're saying, and I purposely wanted to put out there about the long run because I do think that matters. But you're absolutely right, Melissa. In the short term, this needs to be resolved. But what if it isn't? What if this is 2 months, 3 months down the line? The longer it goes with crude oil above $100, the greater the chance of a global recession, but less likely in the U.S. And that's important.
Okay.
For one thing, we're less energy dependent. We produce a lot. For another thing, we've got artificial intelligence, CapEx build out. So there are insulators here. Now, I'm not trying to make, a silk purse from a sow's ear here. What I'm saying is that if you don't get a U.S. recession, which is kind of hard to do under the conditions I listed, I think we'll get through this, kind of muddle through this, but it's not going to be pleasant for the markets.
As the days and the weeks pass by and we are in this war, how has your positioning or view of the markets changed from when we first struck to today?
Well, we started this year believing that the rally would broaden. So we have an overweight to the equal weight S&P 500, which is a way of expressing that more than tech should perform: industrials, financials, energy, materials. Interestingly enough, and you're probably realizing this, the energy has been wonderful, that exposure, as well as materials in the RSP. The further this goes on, we may have to recalibrate that to a more defensive allocation, which somewhat ironically would mean going back to those defensive growth categories of the Mag 7 as expressed in the market cap weighted S&P 500. I do want to be clear for anyone who's listening, whether you're a colleague or a client, that we're not making that call yet.
Right. What will get you to, and I know that's probably not like, a list that you tick off, but what sort of things do you think about?
The biggest thing that we're looking at is the weekly initial jobless claims. Okay. They come out every week, as the name would imply, so that's very useful. It's very timely in terms of saying, has business sentiment been impacted yet? Have businesses looked at the conditions and said, hey, we got to pull back on hiring and those sort of things? Or, excuse me, increase firing. We know there's been very little in the way of hiring. Still, the labor market right now is stable. And as long as the weekly jobless claims tell us that the labor market is stable, the U.S. economy, obviously 2/3 consumption, relies heavily on employment, and we'll be okay.
Why is big tech still as defensive as it might have been once upon a time when it wasn't? I mean, now it's an asset-heavy sort of sector. It relies a little bit on the funding markets in terms of funding the AI trend. And also, even if AI goes off without a hitch and it's wonderful, there could be job displacement, which could also impact the economy, at least in the shorter term as you look at it as a defensive sector.
Yeah, so there's a lot in what you just asked. And I think if we go through the full life cycle of the AI trade, from building chips, building data centers to their actual applications, those steps are not likely to be interrupted by oil, West Texas Intermediate at around $100 a barrel. And even if there are some layoffs, those plans are likely to go through, which is what makes them defensively growth. Now, with regards to what you pointed out about job losses, and obviously that's on everybody's mind with the SaaS apocalypse and whatever you want to call it, To us, this looks like another example of creative destruction. It's happened before. The three of us here have spent plenty of time on this channel at the various floor exchanges where I am 2 to 3 times a week. The population on the New York Stock Exchange is now 300 people. Back in the day, it was over 5,000 people. Now, multiply that by the Philadelphia Stock Exchange, the Pacific Stock Exchange, these things that don't even exist anymore. That subset of the financial industry has collapsed. However, in the last 30 years, financial industry employment is up by 20% in total. Jobs are destroyed, jobs are created elsewhere. If you can time that handoff, it works well. In the tech telecom bust, it didn't work well, so that's the negative example. And unfortunately, Melissa, we're going to have to see how that handoff works.
So your book, I didn't realize this, that each chapter is like modeled after what you do on the subway, basically. So what lesson would we employ today in this market environment?
Stand back from the track if there's someone.
I was looking for that
There's
too.
someone walking around.
I stand behind poles
like
if I have to be near the
screaming
edge.
to himself that don't keep an eye on him.
Well, so there's a lot of analogies, but how about that one right there? You know, if anyone is investing and you go to a cocktail party, you're playing golf, whatever you're doing, and somebody comes up and says, oh, that stock you've got, it's a terrible idea, blah, 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 and they start ranting at you, you know, do look at that as the person on the subway. Treat them a little bit carefully, okay? But if you can get off at the next station and just go to the next car, sometimes that's better than, in fact, most times it's better than getting into a direct bull-bear debate with somebody who may not have the same, mindset as you. But patience, my friend, patience. I don't know, Melissa, how the war in the Middle East is going to turn out. Nobody does. But I do feel pretty confident. It's why I went to that 3 to 5 year time frame. I do feel pretty confident the world is going to continue to turn on its axis, and we're going to be doing just fine. It's a matter of time.
Jim, nice to see you. Thank you.
Thank you for taking the time.
Congrats on the book,
Thank you.
Jim Lebentha.
Coming up.